How to generate passive income by using DeFi Crypto, yield, staking, and pools. There may be many hooks for a newcomer to start using decentralized finance or DeFi, but it can be difficult to overlook the most attractive one: the fact that it is an open opportunity for anyone in the world with digital assets, a laptop, and internet to generate passive income. So let's find out more about how to generate passive income by using DeFi Crypto, yield, staking, and pools. Number 7. What is DeFi? DeFi is an umbrella term for peer-to-peer financial services on public blockchains, primarily Ethereum. With DeFi, you can do most of the things that banks support: earn interest, borrow, lend, buy insurance, trade derivatives, trade assets, and more. But it's faster and doesn't require paperwork or a third party. It removes intermediaries and serves users in various ways, such as facilitating loans. Normally, when people buy crypto tokens and plan to hold them for some time, there is no utility of these coins in the interim. By using DeFi lending protocols, you can put your crypto holdings to obtain a loan. These loans are easier to get and more affordable than the ones you take from traditional banks. DeFi takes the basic premise of Bitcoin, digital money, and expands on it, creating an entire digital alternative to Wall Street, but without all the associated costs like office towers, trading floors, banker salaries, and etc. This has the potential to create more open, free, and fair financial markets that are accessible to anyone with an internet connection. Also, since it's pseudonymous, you don't need to provide your name, email address, or any personal information. Besides, you can move your assets anywhere at any time without asking for permission, waiting for long transfers to finish, and paying expensive fees. Number 6. It is distinct. DeFi is distinct because it expands the use of blockchain from simple value transfer to more complex financial use cases. Bitcoin and many other digital native assets stand out from legacy digital payment methods, such as those run by Visa and PayPal, in that they remove all middlemen from transactions. When you pay a credit card for a coffee at a cafe, a financial institution sits between you and the business, with control over the transaction, retaining the authority to stop or pause it and record it in its private ledger. With Bitcoin, those institutions are cut out of the picture. Direct purchases aren't only the type of transaction or contract overseen by big companies. Financial applications such as loans, insurance, crowdfunding, derivatives, betting, and more are also in their control. Cutting out middlemen from all kinds of transactions is one of the primary advantages of decentralized finance. One of the most popular types of DeFi applications include decentralized exchanges, or DEX. Online exchanges help users exchange currencies from other currencies, whether it's US dollars for Bitcoin or Ether for DAI. DEX are a hot type of exchange which connects users directly so that they trade cryptocurrencies with one another without trusting an intermediary with their money. Number 5. Deposit APY. DeFi has opened up a whole new world for users who, in traditional finance, have been starved of returns for decades. The potential to earn passive income from DeFi is vast, and opportunities abound. The simplest way to earn a passive income through DeFi is to deposit your cryptocurrency onto a platform or protocol that will pay you an annual percentage yield, or APY, for it. The APY is a unit representation to measure the yearly returns earned on investments, including the compounding interest. This is almost identical to how you might deposit cash into a savings account at a traditional bank, although in much of the developed world, interest rates are now a thing of the past, thanks to prolific money printing by central banks over the past decade. Depositing on a DeFi platform can be done with a large variety of coins and tokens, but not fiat or traditional currency. And so, your first step will be to buy some cryptocurrency using a fiat on-ramp. Before you buy your crypto though, bear in mind that because the vast majority of DeFi operates on the Ethereum blockchain, Bitcoin is typically not accepted. Most DeFi protocols will require you to deposit an Ethereum token to earn an APY. Number 4. Lending. One of the other popular ways of earning passive income with DeFi is lending. It is the most commonly followed DeFi activity, primarily because of the emphasis on the early DeFi protocols on lending. For instance, MakerDAO is one of the earliest entries in the DeFi ecosystem, which focus on lending protocols. Interestingly, the concept of loans in DeFi is quite simple. You can find easy avenues for earning passive income. You have to lend your digital or crypto assets to a platform by locking them in a smart contract. Subsequently, borrowers could access the deposited assets as loans by placing their own assets as collateral. The borrowers have to pay back the loan with interest to the platform. Then the smart contracts distribute the interest among the lenders, according to the proportion of their assets locked in the platform. The method of crypto lending is one of the most trusted approaches for DeFi passive income generation for various reasons. First of all, the process of DeFi lending is quite clear and straightforward, which is also easy to use. You can just lock in your tokens in smart contracts for lending purposes. You could also unstake them when you want to take the tokens back. The other reason why we should look forward to DeFi is because of the higher interest rates. DeFi lending can help you earn higher APYs when compared with traditional accounts in banks that offer interest. Number 3. Yield farming. Yield farming or liquidity mining in DeFi relates to the process of earning more cryptocurrencies using existing crypto assets. As an investment strategy, yield farming requires investors to stake or delegate crypto assets in a smart contract-based liquidity pool. The pool reuses the invested cryptocurrencies to provide liquidity in DeFi protocols and distributes a part of the procured fees to users as rewards. DeFi yield farms support the users of tokens such as Ether for investments and rewards. Yield farming is programmed to earn the highest yield or return possible and tends to be one of the riskier investments in the world of DeFi-based passive income. Liquidity pools are used to facilitate crypto trading on decentralized exchanges, which, in return, provides a yield or payment for completing tasks like confirming transactions. The yield success of each pool will be dependent on the strategies implemented on the smart contracts. In addition, the payout will also be determined by the monetary value of tokens invested by the users in the liquidity pool. When a user deposits or lends cryptocurrency to a liquidity pool, the operator or the farmer aims to redistribute the asset with the end goal of the highest annual percentage yield. Number 2. Staking. The concept of cryptocurrency staking has been around for many years now. It is a powerful way of incentivizing users to hold on to their crypto holdings. In return for doing so, these users will receive staking rewards on their holdings per annum. Thus, compared to traditional savings account returns, staking rewards are a far more appealing option. DeFi staking is the process of locking your crypto tokens into a DeFi smart contract in order to earn more of those tokens in return. It is akin to having a fixed deposit with your bank, and the bank pays you interest on the money deposited with them. Most times, the token used for staking is the native asset of the blockchain protocol. The estimated earning potential through DeFi staking will be determined by two factors: the network's reward plan and the duration of the staking. Number 1. Identity of liquidity providers. The third proven approach for drawing promising levels of passive income with the help of DeFi is to provide liquidity. Many popular decentralized exchanges such as Yearn Finance and Uniswap have become successful with the adoption of automated market makers or AMM protocols. The DEXs do not depend on order books that were employed in traditional exchanges. On the contrary, the DEXs generate liquidity pools consisting of tokens pairs with equally distributed values. The equal value of token pairs has opened up the foundation for trading markets on DEXs while offering a plausible solution for how to invest in DeFi for favorable returns. Upon locking in assets in a liquidity pool, you would receive LP tokens or liquidity provider tokens. The LP tokens represent the share of an individual user in the total liquidity pool. Investors can redeem the LP tokens for recovering their stake alongside the revenue generated from swaps in the trading pair. However, be aware of scammers and rug pullers that merely wish to steal your locked tokens and redeem them at liquidity pools, draining your funds. Make sure the farms and platforms you utilize have a good reputation and have published externally audited smart contracts. So, what do you think? What do you make of these passive ways to make money using DeFi crypto? Let us know in the comments below. We hope you enjoyed watching the video as much as we enjoyed bringing it for you. See you until next time. Goodbye.